Hi again, folks. Today, the video is inspired by a recent conversation I had with a client, and it is a perfect example of something that is so concerning for us as advisors, and that is called recency bias. And it's human nature, so it's very common. It's not something that is negative. It's just the reality of recency bias is that what we have recently experienced, we feel is going to continue to happen. And where it's dangerous when it comes to investment management is considering returns. So I'm going to use a whiteboard, just kind of, these are not technical obviously or to scale, but let's take a return and I'm going to kind of draw this out, and this is what this is going to look like. Okay, so here we got 2002, here we got 2008, sorry, let me try and make that clear, and then here we got 2019. And as you can kind of imagine, this is really what the market has looked like over that last decade. So what recency bias suggests is that a client that invests here is going to expect that from this period, that's the return that they would have received. So when they're at this period, they're going to expect to invest or receive the exact same returns that they would through that period. But the reality with investing is very seldom does the asset class that has done very well in a previous year or previous time period is going to continue to do well. In fact, it's almost opposite. But yet at the same time, you got to be careful because you don't want to speculate on that. Whereas the actual return, and this is something people don't realize, as an asset class increases in value, the expected return for that asset actually goes down by that exact same amount. So for an example, if you get a 10% return, that means that every percentage point that you get above 10% as it continues to rise, the expected return going forward actually goes down. Now, obviously it's not exact science, there's not a real measurement, but what it suggests is that as things correct, now the issue is, here's where it's even more dangerous. Let's say you go through this period, this investor. Now, he perhaps was not investing properly here, but what's even worse is that this experience is going to cause him to feel like he has to jump out of the market or jump out of the asset class altogether. And what he's going to do is he's going to sell this to cash and he's going to run. Then what happens is, just like always, things rebound and then you run into that circumstance. The issue is that we can't control how long this is, and that's something for another video, but remember that as this has continued to increase all the way to 2019, where equity returns have been pretty strong, is that the expected return going forward, as it continues to go higher, becomes lower. And so we have to always safeguard against that. We'll talk about that in future videos where we can show you how to protect and create a more consistent return coming out of these periods. But for the time being, I just wanted to emphasize exactly what this recency bias is and how dangerous it is, because as you can imagine, you need to invest differently here than you do here, than you do here, than you do there. And so anyways, hopefully that made sense to everybody. But once again, something that we see a lot of, and a lot of conversations we're having just because markets have been so good, but it really, really creates a scary environment and something to watch for.